Yeah, this is day 11. We're continuing with bankers' acceptances. So, a banker's acceptance starts as an order to a bank by a bank's customer to pay a sum of money at a future date, typically within 6 months. At this stage, it is similar to a post dated check. When the bank endorses the order for payment as accepted, it assumes responsibility for ultimate payment to the holder of the acceptance. At this point, the acceptance may be traded in secondary markets like any other claim on the bank. Bankers' acceptances are considered very safe assets because traders can substitute the bank's credit standing for their own. They are used widely in foreign trade where the creditworthiness of one trader is unknown to the trading partner. Acceptances sell at a discount from the face value of the payment order, just as T-bills sell at a discount from par value. So that was bankers' acceptances. Now we do euro dollars. Euro dollars are dollar denominated deposits at foreign banks or foreign branches of American banks. By locating outside the US, these banks escape regulation by the Federal Reserve. Despite the tag euro, these accounts need not be in a European bank, although that is where the practice of accepting dollar denominated deposits outside the US began. Most Eurodollars deposits are for large sums, and most are time deposits of less than 6 months maturity. A variation on the Eurodollar time deposit is the Eurodollar certificate of deposit (CD), which resembles a domestic bank CD, except that it is the liability of a non-US branch of a bank, typically a London branch. The advantage of Eurodollar CDs over Eurodollar time deposits is that the holder can sell the asset to realize its cash value before maturity. Eurodollar CDs are considered less liquid and riskier than domestic CDs, however, and thus offer higher yields. Okay. Firms also issue euro dollar bonds, which are dollar denominated bonds outside the US, although bonds are not a money market investment because of their long maturities. So show euro bonds. Okay, so that was euros. Now we do repos and reverses. Dealers in government securities use repurchase agreements, also called repos or RPs, as a form of short term, usually overnight borrowing. The dealer sells government securities to an investor on an overnight basis with an agreement to buy back those securities the next day at a slightly higher price. The increase in price is the overnight interest. The dealer thus takes out a 1 day loan from the investor and the securities serve as collateral. A term repo is essentially as identical transaction, except that the term of the implicit loan can be 30 days or more. Repos are considered very safe in terms of credit risk because the loans are backed by the government securities. A reverse repo is the mirror image of a repo. Here, the dealer finds an investor holding government securities and buys them, then agreeing to sell them back at a specified higher price on a future date. Didn't really understand that, but okay. Federal funds, Fed funds. Just as most of us maintain deposits at banks, banks maintain deposits of their own at a Federal Reserve Bank. Each member of the Federal Reserve System or the Fed is required to maintain a minimum balance in a reserve account with the Fed. The required balance The required balance depends on the total deposits of the bank's customers. Funds in the bank's reserve account are called Fed funds. At any time, some banks have more funds than required at the Fed. Other banks, primarily big banks in New York and other financial centers, tend to have a shortage of federal funds. In the federal funds market, banks with excess funds lend to those with a shortage. These loans, which are usually overnight transactions, are arranged at a rate of interest called the Fed funds rate. Although the Fed funds market, uh, okay, yeah, okay. Although the Fed funds market arose primarily as a way for banks to transfer balances to meet reserve requirements, today the market has evolved to the point that many large banks use Fed funds in a straightforward way as one component of their total sources of funding. Therefore, the Fed funds rate is simply the rate of interest on very short-term loans among financial institutions. While most investors can not participate in this market, the Fed fund rate commands great interest as a key barometer of monetary policy. Now we do brokers' calls. Individual who buy stocks on margin borrow part of the funds to pay for the stocks from their broker. The broker in turn may borrow the funds from a bank, agreeing to repay the bank immediately on call if the bank requests it. The rate paid on such loans is usually about 1% higher than the rate on short-term treasury bills. The LIBOR market. This is where it gets interesting. The London Interbank Offered Rate, LIBOR, is the rate at which large banks in London are willing to lend money among themselves. This rate, which is quoted on the dollar-denominated loans, has become the premier short-term interest rate quoted in the European money market, and it serves as a reference rate for a wide range of transactions. For example, a corporation might borrow at a floating rate equal to LIBOR plus 2%. Okay. LIBOR interest rates may be tied to currencies other than the US dollar. For example, LIBOR rates are widely quoted for transactions denominated in British pounds, yes, euros, and so on. There is also a similar rate called Eurobor, European Interbank Offered Rate, at which banks in the Eurozone are willing to lend euros among themselves. LIBOR is a key reference rate in the money market, and many trillions of dollars of loans and derivative assets are tied to it. Therefore, the 2012 scandal involving the fixing of the LIBOR deeply shook these markets. The nearby box discusses those events. So that's why I think on the next page, we'll be talking about the LIBOR scandals in the in 2012. So it's not that old. Yields on money market instruments. Although most money market securities are low risk, they are not risk free. The securities of the money market promise yields greater than those on default free T-bills, at least in part because of greater relative riskiness. In addition, many investors require more liquidity. Thus, they will accept lower yields on securities such as T-bills that can be quickly and cheaply sold for cash. So yields on money market instruments, low risk. They're not risk free. Securities are there. T-bills, at least in part with the greater riskiness. Yeah. In addition, many investors require more liquidity. Thus, they accept lower yields on securities such as T-bills that can be quickly and cheaply sold for cash. Figure 2.2 shows that bank CDs, for example, consistently have paid a premium over T-bills. Moreover, that premium increased with economic crisis, such as the energy price shocks associated with the two OPEC disturbances, the failure of Penn Square Bank, the stock market crash in 1987, the collapse of long-term capital management in 1998, and the financial crisis of 2008 to 9. If you look back to figure 1.1 in chapter 1, you'll see that the debt spread, the difference between the LIBOR rate and the treasury bills, also peaked during periods of financial stress. Money market funds are mutual funds that invest in money market instruments and have become major sources of funding to that sector. The nearby box discusses the fallout of the credit crisis of 2008 on those funds. So first we have the LIBOR scandals, and we have the money market funds and the credit crisis of 08. So we'll quickly read these two things. We just finished with all the different instruments of the money market, and we discussed what LIBOR is and the yields on money market instruments. So as we can see, figure 2.2, the spread between 3-month commercial deposit, wait 1 second. Certificate of deposit, not commercial deposit. That's commercial paper, that's different. So yeah, sorry for that. But yeah, on the y-axis we've been given percentage points. X-axis there's a timeline from 1970 to 2016. So this is the spread between the 3-month certificate of deposit and treasury bill rate. So okay. So as we can see, during all these economic crises, like the energy price shocks, the two OPEC, I still don't know what that means. Maybe something related to oil. I might be wrong. But you know what? Let me just look that up, what OPEC means. Yeah, Organization of Petroleum Exporting Countries. That's pretty much, I was right. So yeah, might be about that. Probably is about that. But anyways, we'll continue with the LIBOR scandals now. So yeah, words from the street. So pretty interesting stuff. Let's get to it. LIBOR was designed initially as a survey of interbank lending rates, but soon became a key determinant of short-term interest rates with far-reaching significance. More than $500 trillion of derivative contracts have payoffs tied to it, and hundreds of trillions of dollars of loans and bonds with floating interest rates linked to LIBOR are currently outstanding. Okay. LIBOR is quoted for loans in 5 currencies: US dollar, yen, euro, British pound, and Swiss franc. And for 7 maturities ranging from a day to a year, although 3 months is the most common. However, LIBOR is not a rate at which the actual transactions occur. Instead, it's just a survey of estimated borrowing rates, and this has made it vulnerable to tampering. Several large banks are asked to report the rate at which they believe they can borrow in the interbank market. Outliers are trimmed from the sample of responses, and LIBOR is calculated as the average of the mid-range estimates. Over time, several problems surfaced. First, it appeared that banks understated the rates at which they claimed they could borrow in an effort to make themselves look financially stronger. Other surveys asked for estimates of the rates at which other banks could borrow, resulted in higher values. Moreover, LIBOR did not seem to reflect current market conditions. A majority of LIBOR submissions were unchanged from day to day, even when other interest rates fluctuated. And LIBOR spreads showed surprisingly low correlation with other measures of credit risk. Even worse, once the market came under scrutiny, it emerged that participating banks were colluding to manipulate their LIBOR submissions to enhance profits on their derivative trades. Traders used emails and instant messages to tell each other whether they wanted to see higher or lower submissions. So basically, they were sort of grading themselves, if you want to think about that. So they were asked to provide a rate at which they thought they could borrow. So they would just like call each other or like message each other and ask what rate they, were going to decide on to expose. Basically, in a crux, that's what it is. So emails and instant messages tell each other, and then we have members of this informal cartel essentially set up a favor bank to help each other move the survey average up or down depending on their trading positions. So they use it to their advantage very selfishly, which is expected, no harm in that. But yeah, to date, over $5 billion of fines have been paid, among them Deutsche Bank $2.5 billion, UBS $1.5 billion, Royal Bank of Scotland $612 million, and Barclays $450 million. But government fines may only be the beginning. A federal appeals court in 2016 ruled that private lawsuits involving antitrust violations may proceed. Customers who borrowed funds at an interest rate tied to LIBOR argue that they were harmed by the collusion of participating banks to coordinate rates. Several reforms have been suggested. The British Bankers Association, which until recently ran the LIBOR survey, yielded responsibility for LIBOR to British regulators. LIBOR quotes in less active currencies and maturities where collusion is easier have been eliminated. More substantive proposals would replace the survey rate with one based on actual verifiable transactions, that is, the real loans among the banks. So as the LIBOR scandals, basically they were helping each other grade themselves essentially, and other people were getting fooled by it, so they invested in it and eventually lost their money due to the fraudulent reporting of the LIBOR rates. Now we have money market funds and the credit crisis of 2008. Money market funds and credit. Okay. So money market funds are mutual funds that invest in the short-term debt instruments that compromise the money market. They are required to hold only short maturity debt of the highest quality. The average maturity of their holdings must be maintained at less than 3 months. Their biggest investments tend to be in commercial paper, but they also hold sizable fractions of their portfolios in certifications of deposit, repurchase agreements, and treasury securities. Because of this very conservative investment profile, money market funds typically experience extremely low price risk. Investors, for their part, usually acquire check writing privileges with their funds and often use them as a close substitute for a bank loan. This is feasible because the funds almost always maintain share value at $1 and the passing along all investment earnings to the investors and interest. Until 2008, only one fund had broken the buck. That is sufficient losses large enough to force value per share below $1. But when Lehman Brothers filed for bankruptcy protection on September 15, 2008, several funds that had invested heavily in its commercial paper suffered large losses. The next day, the Reserve Primary Fund, the oldest money market fund, broke the buck when its value per share fell to only $0.97. The realization that money market funds were at risk in the credit crisis led to a wave of investor redemptions similar to a run on the bank. Fearing further outlaws, the US Treasury announced that it would make federal insurances available to money market funds willing to pay an insurance fee. This program would thus be similar to the FDIC bank insurance. With federal insurance in place, the outlaws were quelled. However, the turmoil in Wall Street money market funds has already spilled over to Main Street. Fearing further investor redemptions, money market funds had become afraid to commit funds even over a short period of time, and their demand for commercial paper had effectively dried up. Firms thought throughout the economy had come to depend on those markets as a major source of short-term finance to their breakdown of the money from salaries she wouldn't have had, and immediate crippling effect on the basket economy, on the broad economy. What am I saying? Yeah, I'm very sleepy right now, but yeah. To end the panic and stabilize the money markets, the federal government decided to guarantee investments in new money market funds. The guarantee did, in fact, calm investors and end the run, but it put the government on the hook for a potential liability of up to $3 trillion. The assets held in money markets funds all the time. US regulators have since approved a series of reforms to reduce the risks of runs on these funds. Institutional money market funds, those serving institutions, and rather than their private investors, are required to float the prices of their shares based on the value of their assets rather than maintain a fixed maximum level of 10 value per share dollars. This limits the incentive during a crisis for investors to complete it and to be the first without drawing funds, while share prices that are determined that are maintained at a non-sustainable level of $1. In addition, funds will have the authority to either eliminate or impose redemption fees of up to 2% if a fungi's assets fall by more than 30 centimeters. Finally, that the rules call for enhanced transparency with greater disclosure of asset value, portfolio composition, and liquidity. So yeah, feeling a lot sleepy today. I don't know why, but can't even read without falling asleep. But yeah, tomorrow we'll do the bond market. Today was a nice short video, 20 minutes maybe a little bit more. But yeah, tomorrow we'll continue with 2.2, the bond market, and then treasury notes and bonds, and yeah, it should be fun. Thanks.